Welcome to Kibir's Tech Dives. I am Kibir. Today I'm honored to have Adrian Mendoza from Mendoza Ventures. He's the founder and CEO. We're going to talk about his business and many other things in this episode. So let's get started. Adrian, thank you for being with us today.
Hey, thanks for having me, Kabir. Excited to talk shop about running and operating businesses.
Before that, let's talk about you. What key experiences that drove you to venture capital?
Yeah. So I before VC, I was a founder. I had two venture-backed businesses, but I want to take a little step back. One of the things I love about your podcast is you talk about your immigrant experience and that of being an entrepreneur. So I have a similar experience. So my dad was an entrepreneur. So I grew up in a household of, I'm first generation Mexican American. My parents immigrated from Mexico in the early 60s. And my dad was an entrepreneur. He had a cabinet carpentry business that he ran out of the house. My mom also had an accounting business that she ran out of the house. And so I grew up in a family of entrepreneurs. So starting running businesses was the most natural thing for me. And so even before we were tech founders, I ran a small agency. I ran, other businesses, a product business, many moon ago. But we started two tech startups, and my wife was the COO. It was with another founder that I knew. And when the company went into acquisition mode, like any founder story, they said, hey, go find something to do. And so my wife and I started Mendoza Ventures. I like to say that we bring our culture and that of being, son of an immigrant into how we work on the business. So I'm not only the founder, I'm the CEO of the business. Like any, so that you guys know, venture funds are like a startup and they're like an operating business. They have an operating, a management company, they have funds, we have employees, but it really is about taking that entrepreneurial spirit that drove us to be founders to then share that with other tech founders.
Today we see a lot of divides in like how immigrants are seen, but everybody forgets this country is founded by immigrants, and also not all immigrants are equal. People are hardworking. Given right mix of things, we are able to create companies. We are able to run businesses, and you are that, I am that, and many people are. And so these stories need to get out that we're not just coming in to suck the blood out of America. We are actually part of the fabric of America. Let's jump to your company. What I understood is Mendoza Venture is not a typical VC. And I have experienced a lot of typical VCs in my life. I know them. And what I would like to say is that it seems like a next gen pre-seed VC. Like, what is the structural design of Mendoza Ventures?
Yeah, absolutely. So a lot of what we built at Mendoza came from our own experience. Just like how you had the experience of running a venture-backed company, I did too. And kind of one of the things that we went through the experience, we raised VC in like 2009, 2010. And a lot of the fund managers that I meet at that time were like people that were like ex-lawyers, asset managers, like they were all people with like heavy finance. It was very rare to meet someone that was in VC that was an entrepreneur. And so the first thing we did is we took that idea of, there was probably about, I think, the three things that make us different. The first one is that the two general partners, the two people that run the firm, have been tech founders before. So we have this lived experience of raising money, of, operating, of just building a business. The second one is I had this interesting experience where I learned that in VC, there is the people that invest in VC as they would invest in us, and there was no transparency. And we realized that if you could open the black box and let there be transparency between the incredible people that are investors in the fund and the incredible people that the fund invests them and put them together, there could just be some amazing magic. And that's one of the things that makes us really, truly different is that we make that connection. We break apart the black box so that those investors who are men and women that have incredible experience, some of our investors are also first gen, parents of immigrants. Some of them are immigrants themselves. Some of them are incredible men and women that have worked at tech companies, at banks, at, most companies you've heard of, and put them with this young talent, and some of them also older talent that are just, building these bridges. And that's one of the things that makes us unique. And then the third piece is where most typical funds of our size would be writing anywhere from 50 to 80 checks. We're only investing in 10 to 12 companies. We're really hands-on, we're really engaged with them. And it all came from our experience of building the business, our experience of raising VC. And we try to translate into how do we make it better? And I love how you said that this is the next gen. I mean, I truly believe that in order to make money in venture, in order to help grow businesses, you have to start thinking in a completely different way.
When somebody becomes an investor, what is your kind of minimum requirement for even an investor?
Yeah. So one of the things that I love is venture has traditionally been really passive. People invest, they get like a K1 at the end of the year, and once in a while they get a newsletter. And they don't even know what it means. And our thing was, how do we create something that's more experiential? So I'll use a good story. One of your prior guests from your podcast, Brittany Greenfeld, CEO of Wabi, a cybersecurity company in DevOps and DevSecOps, um, was talking with her a week ago, and she said, "Hey, I'd really love to build an advisory board." And she started talking about names. Here's who I'm thinking. Five of those six names were investors in our fund. And they were incredible people that have come out of amazing tech companies, out of cybersecurity companies that I've introduced to her. And she's like, "You're right. I should bring these people in to help." And the great thing about it, about this model, is they're not just going to help a little. They're going to help a lot because their money and their time is invested in her. And so it really is, for me, there's a lot of power in bringing in a base of active individuals. It's what we call our investment network, our experts, a network of experts that are there to help. They're advisors, they become advisory board members, some of them have become board members, but also it's a network where they get to meet themselves. People that are actively investing, but they also get a chance to learn how to angel invest and do due diligence. But also they get to be in a community. One of the important things about venture is about being part of a community with like-minded people that come from different backgrounds, but share one goal of they want to help these founders, they want to help these companies.
Awesome. Tell us more about who is your ideal startup that could actually work with you. What do they bring to the table that would be interesting to you?
Yeah, I'll take a step back. And the reason that we invest in those spaces is while I was, starting my companies, I bootstrapped a lot of my businesses building like apps and products for everything from some of the largest banks to asset allocators. I was that guy that they would bring in to build a brokerage app for a bank, to build, an intranet for, one of the top asset managers. And that's how we were able to pay for the first development of our first product, was doing things and getting consulting fees. And so when we started Mendoza Ventures, we were like, okay, what are we going to invest in? We know we want to invest. And, in the first 3 months, we saw everything from doggy dating apps to like, you could just everything with you as soon as you say, hey, I'm investing every type of company to, food apps and like whatever you could think of. And so then we took a step back and we're like, all right, we're not going to invest in everything. Let's invest in spaces that we know. And we're like, well, what do we know? I'm like, okay, we know e-commerce. We know, fintech, because we had built, it wasn't called fintech then. It was just, financial, you know, software for financial, services or financial institutions. We'd built AI products before. We'd built cybersecurity products before. And we're like, all right, in your case, e-commerce left a bad taste in my mouth. I'm like, okay, never going to do that again. But I said, we know that fintech side. We know the AI side. We've built that. We know who the service providers are. We know who the investors are in that side. We know who, how to get through risk compliance. And we're like, that's a perfect space for us to start. And that really has been sort of our true north of it's not about a specific sector. It's are we smart money, going back to your term, where we can sort of be helpful to the company, but also we can help them find customers. We can help them find an acquirer. We could be really engaged with them. And that's for me, the core thing is can we be helpful? But for us, it's able to de-risk the company if we know a lot about their customers, we know a lot about the product, we know a lot about the market. And that really has always been the true north for us.
When I talk to many of the startup that are coming up in my circle of friends and such, first thing they're doing is lawyering up. They're going from one person to a C corp. Now, I noticed that you did mention in an interview that to invest with Mendoza Ventures, you have to be a C corp, Delaware C corp. But if some startup, let's say somebody, solo startup has a great IP, and they're just LLC right now, would you still listen to them and then say convert to C corp if we, in the process of it, or they have to be a C corp ahead of time and some other requirements that you are looking for?
Yeah, that's a good question. So, side story, when I started my first startup, we were an LLC. And people were like, no, you need to be a C Corp, you need to be this. And we paid like a couple $100 to be the LLC. We registered it, $200, we were ready to go. And what we ended up doing is saying, like, look, there's just, a handful of us. We're the founding team. Let's actually focus on running and building the business. And so then when we finally had an investor, then we converted it to C Corp. But it was, look, we know we're going to have to pay for it. We know that it's either $2,000 versus $200. So let's actually build the business first. And then when there's someone that wants to invest in us, then they'll do it as part of the funding round. And that's ended up what happening. I think for most founders, and I also see this for most funds. They go and they spend all this money up front, but they're not ready to take in investors until years later. And for me, it's about always focusing on the business first. Because even like when we ran the business and we would talk to investors, I would be like, yeah, I'm not ready to talk to you. I need to go build a product. I need to go build a demo. And then when I'm ready, and maybe even find a customer, then I should approach you. But the first thing is, it's hard because we're such in a world right now where everyone's like, there's information overload right now. You can Google anything, you can chat GPT anything. But when we started as a founder, it was really hard to find like, how do you take investment dollars? And in that case, you know what? We actually met a great lawyer that was like, guys, don't worry about it. Focus on the business. And wait, when you raise money, then you actually can come back and then we'll figure out a structure where you pay us back only when you raise money. Funny enough, that lawyer, he's actually an investor in my fund now, and he's an advisor. And some of our startups actually get to ask him questions.
That's amazing. The hardest thing for a veteran principal engineer of Intel or Microsoft with extreme and experience and some IP is so hard for them to start. And on top of the starting, the business, they put on these other unnecessary steps, which is that, oh, I got to make a C corp, and then like, wait a minute, I got to do meeting minutes, I got to do this. I
Yeah.
mean, they get
I got
sucked.
to file an annual
So
report every day, and then
yeah.
I've got to file taxes. And I'm like, you're not ready.
So I also noticed that you invest in blockchain companies. And one of the things I wanted to ask, do you have any affinity towards any specific layer one blockchain like ETH versus Solana or anything?
I would say I'm agnostic, but I'm not agnostic. So I'll start off with the first one. I'm agnostic because the most important thing with any blockchain company is that you have a use case that makes sense for you and a use case that makes sense for why you're building it. So many blockchain companies, even now, the use cases don't make sense, or they're trying to stick metadata, or they're trying to just make it harder for what they're trying to build. But at the same time, and this is sort of the root cause with most tech companies. And look, I'm a guy who's also guilty of this. I was on a podcast a month ago as focused on CTOs, and I was talking about technical debt. And I was like, look, when you start and you go fast, you're not thinking about longevity. So you're like, oh, I'll just build something. And then all of a sudden, when you scale, you're like, uh-oh, we've got to build into something useful. that it could actually take on many users and transactions. And I feel that that's the case a lot with the blockchain side, is that a lot of people are building things on a lot of platforms and chains that may not be able to scale with, because you're not just thinking about, oh, is this Ruby on Rails or is this Go? You're also thinking about like, what token are you backing against this? What currency, what cryptocurrency are you going to back the token with? And so part of it is, as you're building in blockchain, it's thinking about the longevity, but thinking about what can you build right now to prove it out and to show that it works. But at the same time, if you do it right and you build an abstraction layer and you build an API driven platform, and there's enough of an abstraction layer that you could rip out the chain and put any other blockchain platform if you have to, then you should be good. And that's the thing about, as a first-time starter founder, is you want to build enough to get the point across, but not overbuild, but build enough that you have at least 75% covered of longevity and not have to rebuild it like in the next 3 to 5 years.
Very, very good advice. One last question about the venture farm, then I will go to some general questions that founders often have. Now, imagine the emerging market of the worldwide emerging market. Now, if I told you there are fintech companies out there that are likely to be public in their country and market. They're leading companies, but they are not exposed to US style venture market. They have revenue, but they could go from 10 million to $1 billion revenue in their own country. Are there funds in US that would invest?
I would say about 95% of US VCs invest only in the US, and it's hard because VC is traditionally localized. The Valley funds invest in the Valley, the New York funds invest in New York. And one of the things that you see is, I would say about, 5% are, really focused on emerging markets, because you've got, and these are usually driven by individuals that have spent time in that market, but also that are tech founders. So I know tech founders that are doing small funds to invest in LATAM. Um, I was just in Mexico yesterday, and I met about 4 different funds led by operators that were investing all across LATAM, but the fund was domiciled here in the US. And it's because they knew the market, they were boots on the ground, they knew the founders, they knew who was doing what, that de-risked it for them. As if, also there's funds here in the US that are investing in Africa, they're investing, in other emerging markets. The key there is that you have, you know, there's a lot of money that could be lost if you're not careful. And that's the fear. But the real opportunity is finding companies where you also have boots on the ground, where you've got local partners, local founders that can tell you whether or not this is real, whether or not it works. Because we've seen this already. Pile of money gets to deploy different places. People lose all that money, and then they realize, oh my God, this must be risky. But they did that without actually knowing the ecosystem.
What is the minimum preparation a startup that has a product or IP, a demo, obviously MVP, or traction? What is the minimum preparation to approach a fund like yours? Like, what do they have to have?
I'll tell about my view, and then I'll tell you my founder's view. So our view is, we always look for customers that have revenue. That like you have a first or a second customer, because I'm a big believer that the more customers you bring in that pay, the customers will tell you who you are and what your product is, because they're going to tell you how much they want to pay, when they're going to pay. You want to have good design partners that can say, hey, and because as a VC, I want to talk to them. I want to ask them, like, why did you pay this much? Would you pay more? Would you pay less? Like, is this solving a problem? And that's my VC view of it, because it's all about validation on the market, but also validation that the customer say, if the customer says, it's okay, but Kabir is my buddy, I wrote him a check, versus someone that says, oh my God, he really fixed something for me. And we, if it hadn't been for us, and it was so important that we paid 90% of the development costs. Because I've got portfolio companies where the founders went to a big e-commerce brand and it was so important that they fixed this problem, they paid for 90% of the development. And then they still bought like a $600,000 license. Well, that's my VC view. My founder view is always about get as much traction as you can, get as many customers as you can, because if you go raise with zero customers and zero product, the money's going to be really expensive. The more you have as customers, as revenue, the less expensive the money's going to get. Because, there are people like, going to an accelerator, they're going to take, 6% of the company, 8% of the company in some cases for that 50 to 100K. Versus, let's say you wait 3 months and you build a POC and you get a customer and you have a signed contract, that's going to be at a much better valuation than giving up 6% of the company.
And also the product market fit is validated. You have real customer paying for your services or product. I know there's a lot of resources online, including ChatGPT, but hearing a human being who is experienced tell us these things would be very valuable. For safe versus price round and convertible notes, can you just tell us what these three things are and which one you prefer?
I think this is a good synopsis because I think I'm going to take my investor hat and I'm going to put in my founder hat. And as a founder, the most friendliest is the safe. And the safe is, a simple agreement for future equity. So sometime in the future, this money will convert. It really equates to an IOU. And, the Y Combinator invented this over 10 years ago. And it's a great way of bringing money in as a founder, because what you don't want to do is price the company. Because as a founder, you want to price the company as the valuation of the company when you have more to show. Because if not, it's going to, again, going back to the money is really expensive. The price round, is going to be really typical for most investors because they actually want to buy part of the company. And that's when someone, can't be you, it's usually a third person, sets the valuation of the company and they say, hey, I'm going to give you X amount for 10, 15, 20%. The convertible note is debt. It is a note that will convert at a certain point, but it is a good way to bring an investment, but you're putting debt on the company. And so when that note matures, it ends up falling into your liabilities of your balance sheet to be like, no, you've got to pay this back. Because if you haven't, if let's say it's a 2-year convertible note, because safes don't have a time, like a time frame. They, if it takes you 3 years to get a price round, it's going to take you 3 years to get a price round. With the convertible, it's got a maturity date. And on that maturity date, you either have to pay it back, or it may convert, or maybe you extend it, or maybe it just becomes debt on your liabilities. So it's really important as you go through as founder to have an open dialogue with the investors of, all right, this is what I prefer, but what do you prefer? Because that's really the most important thing is what is it going to take to get that funding round closed? But again, the longer you go, building your company, selling, the better terms you're going to get on the valuation and how it's going to come in on.
Thank you. That's well explained. So the safe doesn't have interest rate either, right? The convertible note
No.
does, right?
Once in a while, like people will take a safe. So the YC safe is just a standard discount.
Yeah.
When it converts, I'm going to get a 10, 20% discount. But there's no interest rate. There's no, this is what convertibles have. Convertibles have interest rate. They have a valuation cap, so you can't go above a certain amount. Once in a while, we'll see a safe with a valuation cap, and people will try to put interest on it. But then it's like, well, if you're doing that, why aren't you doing a convertible? So, but that's why I think it goes back to the safe is always a lot more friendlier for that first time founder.
Thank you. One of the things you mentioned that I heard is that East Coast versus West Coast. So tell me how I'm in West Coast, but I'm not a VC, but you are. And
Yeah.
So tell us what is the difference in a mindset or strategy? What's the difference between East Coast versus West Coast VCs?
It's funny. I'll tell you this funny story. So we have an office in both SF and the home office is in Boston. I'm an Angelino. I'm from the West Coast, but I live on the East Coast. So I go back and forth. And I forget about so much of the difference in just culture and personality. You're on the West Coast, you know what it's like. And I brought a couple of years ago, I brought one of my CEO founders with me to San Francisco. He'd never been to the Bay Area, he'd never met the VCs. And I dragged him around meeting a bunch of people. And we were going back to the airport to fly back to Boston. And he looks at me and says, I get it now. And I was like, really? What do you get? He's like, I get the difference. He's like, the East Coast is about pessimism, the West Coast is about optimism. And I'm like, all right, you should expand on this. Now I'm curious. And he's like, when I pitched in the East Coast, I'll pitch a VC and they'll look at me and they'll say, well, you have two other competitors. I've invested in one of them already, so I'm not going to invest in anymore. And he made a reference to, well, we just pitched this guy, and he looked at us and said, oh, yeah, we invest in all of the competitors. Because at this point, one of them's going to emerge. We might as well make sure that we've covered all of our bets. And it's a different view of the world of saying, hey, let's invest in the ecosystem versus, oh, I just have one and then I'm done. And that was
Very,
a really a founder view of both, which I appreciated it.
very interesting. Another thing comes up is an advisory board. So a lot of my friendly founders are always interested in building an advisory board. Can you tell us how important it is to have a, let's say, a very experienced industry experience, bringing it into your advisory? Is that even a card in funding?
You've got to have two things, and I want to kind of separate them out is advisors to the company at the same time a customer advisory board. So we'll start with the latter first. It makes sense to have a advisory board when you're ready. When you've got enough sales, you've got enough traction. So we invested in a company out of Palo Alto, and they have two different customer advisory boards, one for banks, one for insurance companies. And they're really building them out to bring in people and engage them, but also to help them sell, is to find people that are in the advisory board that know the industry. And that's great because they're there to help. They're really engaged. They're maybe like 2 or 3 year terms. And then you want to cycle people in once you're starting to sell more, when you're starting to set the scale, when you want to switch to a different vertical. And it's a really organic process, but it's a great way of, as you're releasing new products, as you're, enhancing the existing product, to be like, oh, does this work? And so for me, it checks that box of, oh, they're starting to talk to the industry and they're engaged. Then there is the second piece, which is the first one I talked about was advisors. And this is kind of where I think I see a lot of founders fall down, is they're like, this guy's an advisor and this guy's an advisor. And when people bring that to me, I ask the question like, all right, that guy, or that man or woman, when do you talk to them? And they're like, yeah, I don't really talk to them. Well, have they written you a check or introduced you to a customer? No. Then why are they on your deck? And so we end up like pruning the tree for a lot of these startups to be in like, if they're not active, why are you giving them shares to just sit there and put your use your name? And I think it's an old antiquated concept to have like, oh, I have that guy. And I'm like, well, so what? Like, did he invest or did he get you into his company? If they didn't, they shouldn't be around.
Makes sense, and it is so important because people get hung up on these, these things and don't realize they have practical use. And an advisory board is not just to have some badges. It's actually something that you talk to, and they are talking about you, and it's active duty. And so, yeah, that's actually practical. I think you said it very well. Now I'm going to switch to my very few industry questions. I have only two. I mean, generative AI, Gen AI is everywhere. It's a mega trend. It's been around for a while now, and lots of money has been invested. Billions of dollars are going in. We use AI every day, not only ChatGPT, but actual API to improve our customers' experience. The customers' data is looking better than ever because now is data as eyes on it, which is how I prefer. The AI is my second set of eyes that's looking at the data and actually a 24/7 analyst is working for every single customer, doing stuff that they could not do before, which is amazing. What's your sense of like return on investment for these AI market, where VCs are investing heavily or have invested already probably?
There was a report last week that came out that showed where the majority of all VC dollars went. Do you know that a fifth of all VC dollars went to OpenAI? I mean, that is insane. But it's interesting because we're just scratching the surface on, and right now the majority of investment is going to LLMs. It's going into like a few key players, but there's so much work that has to happen. Like there still really isn't a standard for enterprise LLM because, the biggest problem right now, and this involves all LLMs, like everything out there, is hallucination. It's going to make up something if you're not careful. And you know what? If you have enough data out there, like perfect thing to use, you want to create a job description. There's thousands to millions of job descriptions out there. And if you do this, perfect. It's going to spit out something amazing. Now, if you're using it for financial data, PII, and it doesn't find enough data points, it's going to start making things up. And that's really where you're not still seeing it in a lot of enterprises in B2B sense because of that same thing. And then people are now discovering it. They're trying to put sensitive data in and they're like, uh-oh, I just fed it into a publicly facing LLM and now my data is everywhere. So I think that idea, but the biggest opportunities we've seen is in the enterprise. How do enterprises use it? How do they create things with no hallucination? And then at the other side, how do you build applications on top of them for everywhere from banks, hospitals, insurance companies to everyday use? Like you're saying, your example, customer support. Um, I think we're just starting to scratch the surface. So I'll use a good example. People are talking to me about, oh my God, it might replace jobs. And I'm like, no, it's not. It's actually going to fill in jobs that don't exist. So the number one job in cybersecurity that's unfilled is a cybersecurity analyst. We can't, if universities are cranking people out, there's still jobs that are unfulfilled. That's something that AI is going to come in and fill in so that you could take meaningless jobs where people are just going through, you know, ping attacks or whatever that's there to finally get it useful for people to actually start using the data for decision.
Exactly. I want to ask you, what makes you get up in the morning every day?
Moving millions of dollars.
Awesome. Awesome. So we
Yeah.
finally come to our last round, which is the lightning round, which is a Jeopardy style. Are you familiar with Jeopardy?
Yeah, of course.
So I'm going to give you the answer and you see if you can come up with the question. She loves a puck named Moxie and runs a cybersecurity startup in DevOps security space.
Oh, is that Brittany from Greenfeld from Wabi?
Yes, that's cool. That's cool. Boston is the inflection point for these three industries.
Oh, fintech, biotech, and financial services.
A VC firm that is focused on diversity offers its LP as an expert network for startups.
Oh my God, I heard those guys at Mendoza Ventures are amazing.
Awesome. You got it. Thank you so much, Adrian, for doing this with me. This is my second interview. I think it's going to be an amazing value for anybody. What my plan is, to continue this, I would like to come back to you in a future day and see how everything is going and, what new things you are doing. I really thank you for your time.
I love it, Kabir. Let's do it again.
Thank you so much. Nice seeing you.
Nice seeing you too.
Bye.